Recording is on. Today is Monday, October 26th, 3:30 p.m. section. What we're going to be doing today in just a few minutes is we're going to pick up where we left off with the valuation of Walmart. So the file that you turned in for homework 7 this morning, you're going to need that file. Today's class and Wednesday's class, we're going to build onto that file. And then next Monday, you're going to turn in homework 8, which will be a series of files, 4 Excel files and a write-up based on the work that we do this week. So again, you need to, in today's video and tomorrow and Wednesday's class, basically do everything that we do in class today and turn in those files. Okay. And I'll talk more about the assignment on Wednesday. But before we do, I also wanted to mention the first half of the Bloomberg Trading Challenge is over. And so I'm going to go ahead and share my screen here. And if you go to Files, Bloomberg Trading Challenge, these are the results. Okay, so this is section 301. So this would have been the final rankings for section 301. So again, 5, 4, 4, 3, I don't count 2, 1. Okay, and then each of the sections thereafter. So today, this morning, today's the 26th, the Bloomberg Trading Challenge reset. Okay, so all the teams have gone back to $1 million for the second half of the semester, and you need to trade essentially under the same set of rules, minimum of 10 companies, can't be more than 30% in cash. Now I'm going to give you until a week from today, next Monday, to get your portfolios fully invested. And so in Bloomberg, share the screen here, and go back to Bloomberg. Idea or team message is the trading challenge. And this is section 301. So what's going to happen is this was the first half trading challenge. And for the second half, I just did fall 43, section number 301, 2H for second half. So this would be section 301. So I'll view that network. And each of you have been set up with $1 million as of today. So the only question I would ask is, do any of the teams wish to change their team captain? Or are you okay with the same team captains for the second half of the semester? Because if you are, then you're set to run right now with the same team captains. Otherwise, let me know and I can switch the team captains. But we need to switch if we're going to before you start trading, because the portfolio is tied to that team captain's account. Okay, so something to think about with your teams. But if there are no changes, again, the way you'd get here, idea team message, click on the drop down. What's very important about the drop down is that you will see 2 shared views. You'll see the one for UMD 443 fall 220 section 301, and then you'll see a 301 2H. Okay, and so you want to start trading on the one that is 301 2H. That's the one we're going to use for the second half of the semester. I did not delete the one that's in the first half of the semester, and for all intents and purposes, it's still running, but the grade does not matter. The grades have been finalized for that. All right, questions about the trading challenge? All right, then let's move on to the Walmart valuation model. So I'm going to open it up here in Excel, pick up where we left off. All right, share my screen. All right, so first thing I'm going to do is I'm going to just save this and no longer, this is 301. And this is the part 2 model, I guess I'll call it, till we get to the as is. So what we are trying to do with Walmart is we're trying to now take these cash flows in the CFI tab that we had created during last week's class. And we're going to say, okay, assuming these cash flows come true, what is the valuation of the company? That's the valuation model that we're going to be putting in there in a new tab in just a second. And then what we're going to do is we're going to try and adjust our assumptions to match the current share price of Walmart, which is a process known as an as-is valuation. Okay, so our nomenclature in this class is when we say an as-is valuation, it means we're building a model to essentially match the share price of the company, right? Then on Wednesday this week, we'll talk about 3 more models, a bull and a bear, which are kind of like the best case, worst case for the company, and then a target, which is our target share price for what we think the company should be trading at. And so essentially, you'll then create 3 more models. We'll have 4 Excel files that will be part of your next homework assignment. And then in a few weeks, you'll then be replacing the Walmart model with CVS for your group project. Okay, and then we'll do other practice. But today, what we're going to do, as I said, is continue building the Walmart valuation. So that involves creating a new tab or worksheet. So in this model, you want to hit the plus for new worksheet. And we're going to call this the DCF for discounted cash flow valuation. And then I always like to have this tab at the end. So just drag the tab to the end. So it's the last tab in your model. Okay? And I'll make tabs a little bit bigger so you can kind of see the cells that I'm going to do. But this is where we're going to do our enterprise DCF valuation. Okay? And our first part is it's going to be based on operating free cash flow. And we have created in the CFI a forecast of 6 years worth of free cash flow, okay, from 2021 to 2026. So the first 5 years are going to be what's known as the defined period, and the N+1 or T+1 year, 2026, is going to be what's known as the continuing value period or the perpetuity period. So for the first 5 years, we already have a forecast, assuming our model is true. And we're going to say our first year is, and let's get this relative reference off of the CFI tab. First forecast year is 2021. And I'm going to go down the rows for the years just so that we can eventually print this out on an 8.5 by 11 sheet of paper. So equals current year plus 1, and just have relative years for the first 5 years. So going through 2025. Right? And then for the free cash flow for each one of those years, we're just going to reference the forecasted free cash flow that is on each one of those slides. Right? So in this case, for 2021, our forecast for free cash flow is off the CFI. 2021 is column H. Free cash flow is row 13. So H13. Okay. For 2022, our forecasted free cash flow is off the CFI tab. So for B3 equals column I 13 off of CFI. Our 2023 free cash flow forecast off of the CFI is J13. So just referencing that cell. Our 2024 forecasted free cash flow off the CFI is K13. And our 2025 forecasted free cash flow off the CFI tab is L13. And I'm going to format those to currency. But basically, assuming that our model comes true, these would be the free cash flow forecast for these 5 years. And so what I need to do is I need to present value these. So I'm going to present value these by multiplying those by what we'll call the discount factors. Factors, right? Factors. So present value of free cash flow. Right? So basically, what we're going to do is the discount factor says I'm going to take 1 and I'm going to divide it by left paren 1 plus the cost of capital. And so the discount rate, or R, we're going to use is going to be under the assumptions tab. It's going to be the WACC, which is cell B4, right paren. So that's basically what we'll call the discount factor. So essentially, if I take cell B2 times C2, I get the present value of the cash flow, which is 12,862.36. Right. So again, I'm going to copy this down. So I'm going to make assumptions B4 an absolute reference to the WACC. So $B, $4. I'm going to take cell C2, copy it, and paste it all the way down to cell C6. And then it's going to be discount factor 1 divided by 1 plus R. For the second year, it's 1 divided by 1 plus R squared. So at the end of this, it is shift 6, which is called the caret 2 for squared. Third year, it's 1 plus R cubed. So at the end, I'm going to add a shift 6, 3. 1 plus R to the 4th power, shift 6, 4. And 1 plus R to the 5th power, shift 6, 5. So that my free cash flow is present value free cash flow times discount factor. And again, I can copy and paste this down. So very quickly, I have 5 years worth of present values of free cash flows for my forecast, which if I sum up gives me the operating value for the first 5 years, which is the sum of those discounted free cash flows, which is 59,803,74. Okay. So here's the thing. Companies, including Walmart, probably going to last more than 5 years. So we have to come up with a long-term value for Walmart. This is what's known as the continuing value, which is generally we use a growing perpetuity. So in the valuations, what we do is we do a value essentially for 5 years. And then we say the 6th year is the beginning of what we're going to call the growing perpetuity equation, right? And the equation that we're going to use for growing perpetuities was talked about in the book, but it's basically the key value drivers equation, right? And so it's basically this: NOPLAT times 1 minus G over ROIC divided by WACC minus G. This is the formula for the growing perpetuity that we use in our continuing value. Okay, so the trick is going to be to put this formula into the model with the correct order of operations, right? So the way that we're going to do this, again, I'll go back to the Excel file, is we're going to create something known as the continuing value period. So I'm going to write it here, continuing value. And the continuing value period is the year 6 period will be the beginning of continuing value. So again, as what the book talks about, what we do, back to CFI, is we create the first 5 years of the defined period. We always create an N+1 or a T+1 period, in this case 2026, which is the beginning of the continuing value period. So this represents perpetuity. So if we had done 10 years worth of forecast, we'd have 9 years of defined value. Year 10 would be the continuing value period. If we did 4 years worth of forecast, we would do 3 years of defined year by year forecasting, and then year 4 would represent the beginning of the continuing value period. So generally in your model, you make your last year the beginning of the continuing value period. So for us, that's column M off of the CFI, which is 2026. So using the key value drivers and the year 6 data, we put that here into this cell, right? Now, these are assumptions I'm going to change because what could happen in perpetuity, we're using as placeholders. So I'm going to make the changes on the assumptions tab. So I'm going to put the 4 elements of the key value drivers under the WACC. Make this a little bit bigger. So the first one we're going to need is something called the continuing value NOPLAT. And then we're going to need a continuing value ROIC. And then we're going to need a continuing value G. Okay. So those are going to be yellow cells because I could change them. But these are the next 3 assumptions, in total 4 assumptions to do the key value driver equation. Right. So where do I get my continuing value NOPLAT? Well, for cell B5 off of assumptions equals from my economic profit end of year tab, I want my ROIC, which is row 16, column M is 2026. So M16, approximately 10.5%. Okay. For my continuing value, oh, sorry, that was my continuing value ROIC. Put that in the wrong cell. That should have been cell C6. Right. For my continuing value NOPLAT, I want to go off of my TII, which 2026 is the continuing value year. NOPLAT is row 5. So M5 off of TII. So for continuing value NOPLAT, M5 off of TII. For continuing value ROIC, M16 off of the EPEOI tab. And for continuing value G, G into perpetuity, we're just going to use a default value of 3%. We'll talk more in Wednesday's class about how we estimate a G, but we're going to leave G as a placeholder right now as 3%. And the idea is 2 to 3% is about the long-term growth rate of the US economy. We'll assume a mature company will grow about the economy. Hence, we're going to start with 3% as our default, but that will change. All right, so with these initial assumptions, we're going to now estimate a continuing value for Walmart. So this is hopefully I get it right, the correct order of operations. So for cell B9. So equals left paren, and then we're going to build the equation all off of the assumptions tab. Start out with the NOPLAT, and then we'll multiply by left paren 1 minus the CVG divided by the CV ROIC, right paren, divided by left paren, continuing value WACC, which is B4, minus the G, which is B6, right paren, enter. So that should get us, oh, I have a minus there. Was it negative 258? Should be positive 258. Anyways, negative in front of this. Do this again. Equals. All right, so let's go back. Equals NOPLAT times left paren 1 minus G over ROIC divided by WACC minus G. All right, 459,059.24. Just make sure you get the correct order of operations, because if you don't, like I said, you get some weird data like I just did. So type in the formula correctly. That's the formula. So NOPLAT times 1 minus G over ROIC, all of that divided by WACC minus G. All right, so you should get 459,059.24. That is the value of Walmart, assuming those cash flows come true, as of January 1st, 2026. So it's essentially discounted to a present value, but it's 2026 present value. By the way, January 1st, 2026 is the same as December 31st, 2025 for all intents and purposes. So we're going to use the same discount factor. We don't want to double discount 2026 to basically present value it back to the present. So present valuing that to today, we get 347,931.54 million of what's called continuing value. So this is the value of the first 5 years of free cash flows. This is the value of 6 to perpetuity of the free cash flows, present value to today. So that the overall operating
Professor,
yes, value.
Can you go back to the continuing value equation? Can you explain that one more time?
Yeah,
right.
So add these two up. The operating value is the first 5 years plus the continuing value. All right, which one do you want me to explain? This one? Did you want to look at that cell?
Yeah.
Okay. So
yeah.
So that cell, and I'll leave this up for a second so you can look at the references, is basically just the key value driver equation. So the idea is a company, in this case Walmart, is not going to end on year 5. It's going to last long term. The assumption we make is companies last forever. So if I'm going to value the company long term, I got to value their free cash flows forever. That's the growing perpetuity, rearrange key value driver equation. So that's what we're putting into this cell, into B9. That's the forever perpetuity. And that value was 459 billion. And I then have to present value that, because that's the beginning of year 6 to today. By doing that, 459 becomes 347 today. So this is the value of all the cash flows from year 6 into perpetuity. This is the value of the first 5 years. You add them together, you get the operating value of the company, 407, 735, 28.
Thank you.
Okay. So following Modigliani Miller, now that we have an operating cash flow, operating free cash flow value of a company, we then add the non-operating values. And here's where TFI helps us. So for cell 813. So what we're going to do is we're going to reference off of our TFI. These are the 3 non-operating assets and liabilities we have to, the buckets that we have to value. So we have one called excess cash. We have a second one, which is the non-operating assets less the non-operating liabilities. And we have a third one, which is the long-term investments and receivables. Okay. Those are the 3 non-operating assets. So this is the assumption we're going to make. The assumption we're going to make is that long-term, I don't invest in a company to do non-operating things. All right. By definition, they're not what they're supposed to be good at. So long-term non-operating assets should be NPV 0. Right. You're kind of breaking even on those. Right. So any non-operating value is the non-operating value today, and it's not going to grow or shrink in the future. Now, again, you can always choose to override these assumptions, right? For if you really believe the non-operating value could be more substantial than this. But for now, we're going to use the current non-operating value of the firm for the non-operating value of Walmart. So for excess cash, cell D13 equals, from the CFI, the history, the historical, the actual reported excess cash balance is off of TFI. It's column G, which is the last reported year, 10. Okay. For the non-operating assets value, it's off of TFI. That would be G11. So reference equal G11. And if they have long-term investments, it would be off of TFI G12. So if I were to sum these 3 up, I would get what's called the non-operating value of Walmart. And that would be the sum of the 3 above: the excess cash, the non-operating assets, less the non-operating liabilities, and the long-term investments, or 2591.72. Okay. So I have 407, round off 408 billion of operating value. I got about 2.6 billion of non-operating value. Enterprise value is operating value plus non-operating value. That is my enterprise value. So again, assuming my assumptions come true, that's 410 billion, 327 million. Right? It is this enterprise value, as we know, that you can use to pay off the debt and the equity holders. So here's the point. We're going to pay off all of the debt and all of the non-common equity holders, and the common equity is residual value of whatever's left, right? Again, this is where TFI helps us, because from the enterprise value, if I go to my TFI, who has to be paid off? Well, I have to repay off my retirement-related liabilities. I have to pay off my interest-bearing debt. I have to pay off my preferred shareholders, not my common equity. I'm solving for common equity. And I have to pay off my minority interest shareholders, because after those 4 groups are paid, the last stakeholder left is the common equity holder. So they are the residual value. They get what's left after everybody's been paid back. So how much do I owe them? Well, today I owe my retirement related liabilities, again, off my TFI. The actual balance is column G, 15. Interest-bearing debt is off of the TFI G16. Preferred stock, if Walmart had any, would be off of the TFI G18. And minority interest would be off of the TFI G19. Those would be the four stakeholders in dollars that I would owe money to. And whatever's left would be my common equity value. So basically, it's the enterprise value minus the sum of all the non-common debt and equities. So basically, I get a common equity value of 331 billion, residual 11 million, after all of the interest-bearing debt and equity is paid. Now, if I took this common equity value and I divided it by the shares outstanding, what would be left would be the share price of Walmart. So that's what we're working towards. We're working towards getting a share price of Walmart, right? So I need to know my shares outstanding. So here's
excuse me, Professor. Could you just go back over the formula for common equity value again?
Enterprise value minus those four things.
Okay.
So
Thank you.
So I probably could have added those up, but basically it's enterprise value minus the four debt and non-common equities, the preferred and minority shares. So all those people get paid off. Whatever's left, residual equity value divided by shares, share price. So now I need a share count for Walmart. Okay. So here's the thing. What we're going to do is we're going to go to Bloomberg. So let's see, back to Bloomberg. And what we're going to do is we're going to look up Walmart. And to get the share count, we're going to go to a screen called DES, which is security description. And in the security description for any company in Bloomberg, right down here, there's a current shares outstanding, 2,833.8 million. Okay. Now I'm going to take a screenshot of this and save this as a file that we'll use because this is going to be your blueprint. Now the file is going to be called WMT, my format, dash for ticker slash screen, DES is the screen. You can see there's going to be two more screenshots we're going to need. Now I had taken this screenshot in section 101, the 11 a.m. section, and just for consistency across the classes, because obviously the share price changed a little today, I'm going to use the screenshot from the earlier class, right? Just so we all have the same model, right? The price at the time. But the point is, on the DES screen, this is the share count that we're going to use. Okay. So
should we be doing this as well?
you're going to need this share count. Yes.
Okay.
So I'm going to stop my share. And what I'm going to do is back to share screen. For now, I'm going to share the desktop. I'm going to go back into Elms, and in the files section, there is a Walmart folder. And in the Walmart folder, I'm going to put these three screenshots. I'll try. I want to go up here. Upload. Try this way. Upload. And whack. All right. I don't know why they just upload and I click and drag. But anyways, so you can see the screenshots here in the DES of the DS. And then the other two screenshots we're going to take are in here as well if you're following along. So back to our Excel model.
Do you have that screenshot uploaded for all your sections? Because I was in the 2 p.m. section.
No, I do. This is I'm just uploading them now. But it's the day that we use is on the 11 a.m. section video. but I'm uploading the screenshots right now. So they're there for everybody to see if they're watching the video. So back to shares outstanding. So from the screenshot for shares outstanding, which you could have gotten from Bloomberg. So let's go here. This is the screenshot of the DES screen just earlier in the day. So the share price we're going to be working to is 142.13, which is the same as the previous sections. And then secondly, the shares outstanding doesn't change, 2833.8. So here's the deal. We don't want to put the shares outstanding here on our DCF screen because it's going to change when we switch to a different company. So this is going to become an assumption. So I will change it. So in cell 9, shares outstanding, and I'm going to make that yellow. And I'm going to put in from the screenshot the 2833.8, 2833.8. So 2,833.8 million shares. And then in my DCF valuation tab, I'm going to reference that number equals from the assumptions B9. So that my share price is going to be equals the common equity value divided by the shares outstanding. That would be $117 per share. Right? So essentially, if my values come true, that would be my share price. Right? Now, let's go through the rest because we're not done yet, because we got to put in some more realistic assumptions to get close to Walmart share price, because obviously we got to get to 140, 142, right? So what do we need to do? So before we go any further, did everybody get to 116.81? Hopefully. Okay. So now what we're going to do is we have to put in more realistic ratios. Since we got the basics of the model working, so our CFI and our ratios that create that CFI create a share price. So as we change the ratios, the share price will change. So to get to the as-is valuation, I need to know two things. So I need to know the actual or observed share price, which I'm going to put right here on the ratio screen. And the reason I'm going to put on the ratio screen is because I'm going to change ratios to get close to this price, and I don't want to keep jumping back and forth. So I need to know what the current share price is. And that is going to be from this morning, 142.13. Now I want to use the current share price, but I'm using the 11 a.m. share price just because I want to have consistency throughout all of our classes today. So that's the price that we're going to use for Walmart, 142.13. It's not too different than it is right now. And then I'm going to have what I'm going to call the model share price, which is what does our Excel model or valuation model calculate for a share price. And that is not going to be yellow. And that's going to be a reference equals of my DCF valuation cell D30. Okay. And so the key to what we're about to do in the as is valuation of Walmart is we want these two numbers to match. Now, I'm going to define the range that you have to be in as within $1. Okay. So you don't have to get to 142.13. You get to like 142.01 and that would be fine. But within $1 of the current share price is the as is. And the general idea of an as is we know the price. So we want to kind of work backwards in our model to figure out what cash flows lead to that price. That's called an as is valuation. Okay. And that's something you're going to do every time for the rest of the semester. Okay. So this is part of your upcoming homework assignment with this models. Now that we have this, how do we adjust this model to get the share price close? Well, we got to think about what are the key value drivers that we need to change. Okay. And the key value drivers that we need to change are associated with free cash flow. Because it's really, you can see it here, it's the operating value, which matters a lot more than the non-operating value in terms of changing the share price. Okay. So what are the drivers of free cash flow, right? Well, basically, you can see it. It's gross cash flow and gross investment are the drivers of free cash flow. And so if you think about gross cash flow, on the ratios, three things drive no plat, which is the key to gross cash flow. It's revenue, so therefore the growth rate, it's EBITDA, and it's tax rate. So if you know these three numbers, which is why they're highlighted in gray, these are the three most important drivers of no plat, which therefore become the three most important drivers of free cash flow. Okay. Now the other piece is we need gross investment. Here is where these numbers help you. I told you that we would keep all of these balance sheet ratios as a percentage of sales for two reasons. And I left off the second reason. This is the second reason. Because all of these balance sheet ratios are a percentage of sales, when we grow sales, we grow the balance sheet. And because the model is growing balance sheet relative to sales, the difference between current year balance sheet and last year's balance sheet automatically calculates your gross investment. So when we forecast free cash flow, we actually forecast free cash flow by forecasting no plat, growth, EBITDA, tax rate, and we auto forecast gross investment by tying the productivity of the balance sheet to stay the same. Okay, which is another way of saying, look here at the historical invested capital sales ratio for Walmart. It's been in a fairly narrow range, 29 cents per dollar. And so that's the point. Like for the Walmart's balance sheet, they're spending a similar amount of invested capital per dollar every year. Therefore, if we grow at the same percentage of revenue that we've had before, then it creates the CapEx to drive the free cash flow. So back to this. What really matters is we're going to leave the balance sheet alone. Unless the productivity of the balance sheet changes dramatically for a company, which most companies do not, you can see Walmart doesn't either, then what we're really going to focus is for the 80-20 rule evaluation are these three numbers. Now, eventually you can change anything you want, but those are the three most important numbers for your valuation. Okay. And essentially, the other key to this in the forecast, just to make sure our balance sheet's not out of whack, is this last line of ratios we want to fill in, which is invested capital to sales. So equals from TFI, column H is the first one, forecast. Operating invested capital is H8 divided by sales, which is income H3. And that's not a percent. That's that. So what you can see here is if I take my invested capital to sales ratio and I leave these ratios and growth rates the same, I'm still at about 29 to 28 cents. So I'm in the productivity range of what Walmart has been historically. So suggests that I probably don't need to change the balance sheet ratios. I can focus on the income statement. That's the 80-20 rule. All right. So what are the three numbers? Tax rate, EBITDA, revenue growth rate. All right. I need a realistic tax rate for Walmart. Where do I get a realistic tax rate for Walmart? We're going to go back and get this from Bloomberg because the analysts that are analyzing a company are trying to do the same thing that we are. So if you go to the company, you go to EVT, which is company events. And one of the things you can do is you can look for the last earnings call that the company had. And so the last earnings call that Walmart had was back here in August. This was their earnings call. And this, if you hover over the icon, is a transcript of the earnings call. So one of the things that Bloomberg does is live as a company is doing their quarterly earnings calls for public companies, Bloomberg is listening and real-time transcribing those calls using machine learning. So essentially, this is a transcript of Walmart's last earnings call. And here's the key. In this transcript, the analysts are trying to do the same thing we are. They're trying to figure out the tax rate. So one of the things we can do is we can come over here and we can search this PDF and see all mentions of the word tax. Right? Now, when I looked at this earlier, we actually see in the last earnings call, they didn't really talk about, which is unusual, what their tax rate guidance would be going forward. Okay, so we can go look at other calls, but I'm going to give you one other source of information to find the tax rate. BRC, which stands for the Bloomberg Research Portal. And these are the analyst reports. Okay. And what I'll tell you is that if you go back around the earnings call, which I did this morning, and here is a JP Morgan. JP Morgan is a good bank for doing this. A JP Morgan analyst report. In their analyst reports, I'll click on this. This is off of BRC. They have a forecast for the tax rate because just like us, they are trying to come up with a tax rate for Walmart. So again, if I search for tax rate, as an example, then you'll see that this is JP Morgan's model of Walmart. It's at the bottom of the PDF. Just search in the same file. And you'll notice that this is JP Morgan's forecast for the tax rate for Walmart. And if I can go to the out year, 2021, what they're using is a tax rate for Walmart is 25.3%. That's the forward tax rate that they're using, which is probably pretty similar to the other analysts. So for our model, tax rate instead of 24.4, 25.3. And that's where we got the number. Okay. So there's two places to get the number, right? One is you can get it from the analyst report. Right. And I'll save this analyst report, save, download, and I'll put this in the Walmart file. Two, you can also go to the transcripts off of the event screen and you can get it there. Okay. I actually had to use that order first. Start with the transcript of the earnings call and start there for getting the tax rate. Then if you can't find it there, go to the analyst reports. But when you look for companies, you need to know what a forward tax rate is going to be. And that is the number that we're going to use. Okay. By the way, if the Democrats win the election next week, there's going to be a lot of talk very soon about whether or not these tax rates go up. Because one of the Biden's promises is to raise the corporate tax rate to 28% from 21, which means we'd actually have to adjust the tax rates in our models going forward. But right now, the Democrats haven't won, so we have this tax rate to use. Okay. All right, so continuing on, we have the tax rate. Now we need a forecast for revenue growth rate and EBITDA. So again, here's where Bloomberg will help us, because in Bloomberg, go back to Walmart here, WMT US equity, under EEO, this is the earnings estimate overview. The sell side analysts that cover Walmart, this is the consensus estimate for Walmart sales for the next 4 years and Walmart's EBITDA for the next 4 years. So since we have to, in the as is, represent what the current share price is, the analyst consensus is critical to the current share price. So rather than trying to create our own consensus for the current share price, we're going to use the current models of the analysts, kind of the wisdom of the crowd, to say this must be what the market is thinking Walmart's going to do. So for the next 4 years, here's the revenue and here's the EBITDA that we need to put into our model. So this was screenshot number 2. Take a screenshot, save the screenshot, and that was the file. Just so I pop it up from earlier, which was the Walmart EEO screenshot from earlier today, okay, which you can get on your screen. But these are the numbers we need to put into our model for revenue off the income tab and for EBITDA. But I can't put them in here directly because those are not yellow cells. I put them in here by changing the ratios to get those numbers. And so to get the correct ratios for revenue growth rate and EBITDA margin, what I'm going to do is go back to the assumptions tab and I'm going to start putting them in here. So my first year is 2020. And I'm going to do 4 years. So that plus 1. And then for 4 years. And then I need a, what I'll call consensus revenue Revenue, tell, and I need my consensus EBITDA so that I can get my EBITDA margin percent. All right, so for 2020, revenue 552.36. For 2021, 558.618. 558.618. For 2022, 577.258. And for 2023, 596.73. For EBITDA for 2020, 33,969. For 2021, 35,025. For 2022, 36,387. And for 2023, 37,637. All right. These are yellow currency. So my margin is the EBITDA divided by the revenue. These would be my EBITDA percentages. So they're sitting there in plain sight. Save this file. For us to use in the model, we just had to kind of calculate them. So here's the point. For the ratios, these are my EBITDA margins. So equals from the assumptions tab, 2020, an extra decimal place, copy to 2024. Now I'm also going to unyellow these cells because I'm no longer typing them in here. I'm creating them from the consensus estimates. So next 4 years of consensus estimates, create those EBITDA margins, use those EBITDA margins as my next 4 years worth of forecast. Do the same thing with the revenue growth rate, right? By the way, 1.9, 1.9, 1.9, that's not the growth rate. The growth rate is based on these numbers. So the formula for revenue growth is current year minus previous year divided by previous year. So let's solve for the right growth rates. So 2021 equals left paren, current year growth, or current year revenue is assumptions B12 minus last year's revenue, income G3, right paren, divided by G3. So basically 5%, right? So again, for 2022, same process. Assumptions, current year revenue is C12 minus B12. Take all of that and divide it by B12. So then they're going to grow 1.5%. And then 2023, the consensus is current year minus previous year divided by previous year, 3.3%. Actually, I got my year plus one here. I got the wrong years. Plus one. 23. And for 24 equals left paren. Actually, there are years here. Current minus previous, take all of that divided by previous. And you could have just copied and pasted the cell over. And then I'm not making these 4 years yellow anymore.
Professor,
Yes.
Could you redo the first year for 2021? Could you like show us how to do that again, please?
So it's B12, assumptions B12, which is the first year of revenue, minus income, which is the historical 2020 year, G3, divided by historical income, G3. So equals left paren, that minus income last reported year, which is income G3, divided by last reported year G3. That's the 5%. So that's the revenue growth rate. Now, I could have cheated. I didn't, but I could have cheated. And I could have actually gotten the growth rates right here because those are the numbers. Right? Bloomberg actually calculates these growth rates. Right? So instead of doing this, we could have referenced another field within Bloomberg and got those. But basically, we're just manually calculating those numbers. All right. So back to this. I'm getting closer to that dollar, but then I have one other thing I had to change. Got my out year margins, out year growth rates, but I also got to change my WACC, right? Because this was the WACC just randomly, and I need Walmart's WACC. So screenshot number 3 for Walmart is WACC, hit enter. And Walmart's WACC today is 4.4%. Take screenshot. That's the third file. So basically 4.4. And that gets me to, using 4.4, that gets me to share price of $291. And I need to get to 142. So obviously the WACC has a big impact on the share price. That drives the value of the model higher, right? So the question is, how do I then get this to be close? Well, if I really look over here in the DCF, most of Walmart's value is continuing value, okay? So the most important part of my valuation, this is where I'm also going to try and match, is I got to get this continuing value, which is really these 4 numbers. I'm not going to change the WACC. I could change the NOPLAT, but it's probably not going to be that different. Could change the ROIC. It's probably not going to be that different. The final big number is our G. I need a more realistic G, right? So again, I'll just quickly equals here, and I'll go back to my ratios. I'm going to put this here, copy, paste, right? And I'm just doing this, actually I'll move this over one column. Right. And this is just my laziness, so I don't have to keep jumping back screen or screen. But again, I want to get this within $1, and I need a G, which will get in this to be $1. So I've got to back solve this. So here's the point. If their G is 0, share price drops to 122, and I got to get to 142. So obviously they have more than 0, but it's less than 3. So what if the G were 1%? And I'm getting pretty close. So 0.0085. And now I'm at 141.64 a share, which is about 50 cents from Walmart's actual share price. And I'm going to call that my as is. Save. File, save as is. And this is where you need to end up today. So what we've done very quickly with our model is we've taken the cash flows, which were a baseline, and just repeated 2020. We created a DCF. And then basically with the DCF share price, we said we got to match this to the real share price. So what we then took our model to do is we said, okay, let's start adjusting the ratios. What ratios do we adjust? We said we're going to leave the balance sheet ratios alone because they're pretty much tied to sales, and we're going to assume the productivity doesn't change. We put in a more realistic tax rate. We put in for at least these 4 years the EBITDA and revenue growth rate that the analysts are actually expecting for Walmart. And we didn't really change these 4 numbers. We'll talk more about that on Wednesday. And then to get close, I just changed the G which we had a placeholder of 3% down to 0.85. And that got to Walmart share price within 50 cents. And so, by the way, this spreadsheet that we just came up with is not all too different than JP Morgan's, because to get the Walmart share price, you have to have a DCF that looks something like this. And that's why we call it an as-is model. This is where you need to end up today. So before we end, questions.
Can you just show how you did the EBITDA margin percent one more time on that page?
So it just took B13 divided by B12. So dollars divided by dollars equals percent.
Thank you.
And then just copy that over for the 4 cells.
Could you also show how you plotted out the change in revenue growth?
How did I change? You mean the
Yes.
formula here? So the formula
Yeah.
for revenue growth rate is current year minus previous year divided by previous year. I just repeated that formula 4 times. And so first what I did was I put the revenue growth, the revenues, the actual revenue assumptions here, next 4 years. And then I just calculated change. So for example, this is the current year minus previous year divided by previous year equals 5%. Same thing for 2022. Current year minus previous year divided by previous year, that's 1.5%, 3.3, 2.3. Now, obviously, it's not exactly 1.5% because there's more decimal places, but essentially, current year minus previous year divided by previous year, just solving for it. And that's what I said. If I had cheated, I could have gone to Bloomberg. I don't want you to do this, but they should match if I click on the growth tab. So it's the screenshot. This is if you go to EEO in Bloomberg. This is doing the same thing with growth. It just does a percentage change, 501, 152, 32. But I wouldn't want to put these in because, again, I want to solve for these in our model. But regardless, that's where they're basically, we're putting in those growth rates. We're just solving for them into our model. So this is what the market thinks, kind of consensus estimates of the analysts. Walmart's going to grow. This is about the margin they're going to get. We're assuming the productivity is going to stay about the same. Tax rate's going to go up a little bit. So what's left by process of elimination? G. So adjust the G to get to the price. And as I said, on Wednesday, we'll talk more about refining G, refining the out year forecast and getting a little bit more nuanced, but we're getting fairly close to some of the drivers of Walmart stock. And this is called an as-is valuation. Other questions about where we are now? Are you getting this number? 142 or 141.64? Because that's the number we all need to get to.
Yeah, I think we got that number.
Okay, good. We all want to be at that number. Any questions before we stop for today? All right, preview. So again, if you got to the 141.64 and you have all the things in here, you're good for today. What we're going to do is we're going to take this file. Don't lose this file. And in the next class, what we're going to do is we're going to, as I said, get a more nuanced as-is valuation by getting a more realistic perpetuity values. And I'm going to show you how to do that using the multiples. Okay, so we're going to adjust a couple of these numbers. And once we do that, we're going to get true as is. And then we'll create 3 additional Excel files from this one. We'll create essentially a range for the company. Best case scenario for the next 12 months, which we're going to call a bull. Worst case scenario called a bear. And then where in that range do we think our value for Walmart's going to be? That's our called our target. So we'll have 4 share prices for the valuation of Walmart, and that will complete our valuation. That's the process that you're going to have to complete for next Monday. You'll then have an individual homework assignment. You'll do this for another company yourselves. And then you will have a group project where you're going to do this for CVS Health. So that's what's upcoming. If you have any questions, feel free to let me know. If not, this is where we're going to pick up during the next class. So make sure you save this file individually. Again, I'm not handing out a solution right now. So you have to build this file yourself, and you can't share files, right? Because if you don't build the file, it's too complicated. You won't know what's going on, right? So you got to build it yourself and get to this point to be able to do the homework assignments and turn them in. You can't turn in somebody else's files. So that concludes our class today. I'll put the video up on Zoom and it'll be up on YouTube shortly. Have a good day.
Professor, I had a quick question. I wanted to talk to you about something privately. How could I make an office hours appointment with you?